Good evening and welcome back to the Australian Stock Market Show. My quote for tonight comes from Florence Nightingale, who said, "I attribute my success to this. I never gave or took any excuse." I know many other successful people say the same way of thinking is the reason for their success. Frankly, there is no excuse for burying your head in the sand when it comes to your financial future. Sayings like, "I've not sold and so I'm not losing money," or "I will sell when it comes back to my buy price," and even this one, I hear a lot, "As long as I'm receiving dividends, I'm fine." Seriously? Your ultimate success in the stock market over the long term comes from understanding how to be successful, and that is what we want to share with you. No excuses given or taken. Tonight, Dale and I continue our upfront, no BS approach to all things stock market. For our main topic, we share our thoughts on whether the stock market will crash and whether investors can protect their portfolios from a sell-off by owning stocks that pay the biggest dividends. We also share with you our stock tips for the final quarter of 2022. So make sure you stay tuned. Hello, I'm Janine Cox, your host for tonight, and joining me is Dale Gillham, and we're Australia's most trusted stock market educators. How are you?
I'm super fantastic.
Wonderful.
I'll get better.
Glad to hear that. I know you had a good weekend.
I did.
You sound very husky. What's going on there?
I'm just putting on my sexy voice.
Have you got a cold or something?
Oh, I feel fantastic. Geelong won.
Oh, so that's what it is. So you were home alone, yelling at the top of your voice, and nobody got it on film.
I had the whole theatre room to myself because nobody wanted to be near me. No, I'm not that kind of support. Like I don't get rowdy and yell at people and things like that.
But it sounds like you did.
Well, you got a big theatre room, volumes up. How do you not get excited over a game like that and beating Collingwood by a goal in the last 2 minutes?
Well, that's important, isn't it?
Doesn't get much better than that.
Does anybody actually like Collingwood other than Collingwood supporters?
No, Collingwood supporters do.
That's what
I'm sure of that. And their mother loves them. I'm sure of that. They do anyway. But God, can we move on and not talk about football?
Okay, fine.
Anyway, well, before we get into our first segment for tonight, again, we're going to take some live calls on the show. So if you want to chat to Janine and I and ask us a question that has been on your mind, then this is your opportunity to pick up the phone and call us now. We generally want to support you, so please show your support for us and the show. The number you need to call is 0392909988. That's 0392909988. To get things started, the first person to call into the show right now will get a free copy of my latest book, Accelerate Your Wealth. So pick up your phone right now. I know it's in your pocket. Get it out there and start dialing.
While we wait for you to call, it is the first Tuesday in the month, and this means that we take a look at the Australian stock market. So let's get into the charts. Okay, on your screen right now is an All Ordinaries Index. Now I'm going to put my glasses on. Yep. And that's a monthly chart. You know, I'm loving this husky voice thing. I'm just loving the fact that it's actually on film so that I can prove it. So you can prove when we talk about this in future at some point. All right, now we can see there, as Dale said on the screen, is the chart of the All Ordinaries Index. What we've done is we've actually overlaid a line chart of the top 20 shares. So we obviously know that our market is dominated by a lot of the big heavyweights that's controlling the movements of the market. So therefore, what we've been saying for so long is if you just watch what's happening with the top 20 shares, then you'll understand what's happening with the markets. People get a bit stressed about having to choose stocks from so many, don't they? They do, and that's the biggest thing is, like, how do I find stocks to buy? And I go, well, you make it hard for yourself. Yeah. Just narrow your whole focus down. That's why my first book, we talk about the top 20 shares. Even this one, we're doing the top 20 shares in that one. Okay. So, you know, just show people that's really the ones you need to understand to look at the market and the market direction. But I mean, even with the top 20, the volatility of those shares can change between stocks. So, you know, you could find 10 stocks in the top 20 that perform better than the other 10, which you've shown in your book. Not right now, you can't. Because out of the top 20 stocks, 2 have done over 20% this year. Only 2. Yep. You know, we're talking about 67% of them are down at this time, from 1 January. So that's why the market's been more bearish this year. Well, the market's been sideways and down from the middle of 2021. It's done nothing since then, isn't it?
So, I mean, there was a glimmer of hope last month when the market started to move back up. It looked like it was on its way again. A big reversal the month prior, so July, reversed strongly and then continued higher. But at the moment, we're just seeing a bit of a breather in stocks.
Yeah, I do think too. You know, I mean, obviously people can see my report from yesterday, but I think a couple of weeks down, that's fine. Maybe one more week down.
Look, I mean, we're going to talk about the scenarios tonight, but one of the worst case scenarios could be that the market actually falls from here around 10 or 11%.
Which is what I was saying the Dow and the S&P could do as well.
But we'll talk more about the upside. We don't want it. It's not all doom and gloom. It's actually quite positive for some stocks out there, and some of the patterns that these stocks are forming on the market. You know, you can wait so long. You can wait decades for these sort of patterns to unfold, can't you? And we're seeing
I'm getting
it now.
excited, and that's what I was saying yesterday in my report. I was just so excited about the market right now. So, but
all right.
I think we better keep those secrets till later on.
Thank you, and that is it for our thoughts on the Australian stock market. Now it's time to get into our first email for the night.
Alrighty, our first email question is from Michael, and Michael says, "Hi Dale and Janine. I had a question about investing more capital into WDS. Now, I am 24 years of age and consider myself a long-term investor. I decided to only put a small amount of capital, about $790, including brokerage fees, on the 8th of October 2021. Now, my average purchase price was $25.40 per unit. I really would like to invest more in this stock for its long-term growth and dividends. However, I feel that I'll increase my risk by doing so. I'd love to hear your thoughts about entering." Michael, I love that question.
It's a good question. The short answer is, of course, yes. When you buy more of the same share, you are going to increase your risk in that share. If you're doing it sort of to try to even up the positions in your portfolio, then that can be a good reason if the stock's still rising. But then, you know, it's going to be an interesting situation for someone if they overload a particular stock in their portfolio and then the stock corrects, then it's going to have a massive impact on their overall.
When you've got under $5,000, you do have to break some of the rules that we talk about. You know, $750 in the share, it's not really enough, because obviously with brokerage and everything else, what growth you're going to get. So I don't mind it topping up a little bit on that, but you do increase your risk a little bit. But, you know, we're not talking sheep stations, you know, like millions of dollars now.
Look, I actually thought it'd be worse to top up when you're dealing with such small positions, in actual fact.
I'm thinking of the opposite.
Look, we're divided on this one, which is fine. I'm happy to be
well, you're allowed to be wrong.
Adversary.
That's fine. That's okay.
All right.
But I do think it's great that he's gone in and got it, and he's putting some money into the shares.
Just looking at the stock, this would have to be one of the shares that's actually done well this year.
There you go.
And it looks like it's continuing to do so. So
you're suggesting he buys another share?
I would be suggesting another share, but, you know, when the time's right and when it looks
Top
like
20.
It's moving up. Yep, top 20.
Another share. So there you go. All right, Janine, we've got a caller on the line. Oh, no, we don't have a caller on the line. I'm sorry, but we need to get into our next email.
Fantastic.
I jumped the gun, sorry.
That's okay. You're allowed to make mistakes. Touché. Before we get into our next email, if you enjoy watching our show, then hit that like button now, particularly based on what I just said. Our next email is from Nathan. "Hi Dale and Janine, I'm new to trading and I'm currently making my way through your How to Beat the Managed Funds by 20%. Let's just say there have been a few aha moments. I'd love to get stuck into your diploma course sometime soon, but might have to wait until I've finished my current masters. Oh wow, and my toddlers get a little older. That being said, I was hoping you could have a look at Lark Distilling for me. I did some dough on it a while back, rookie error. Bought the falling knife, but it now appears to be heading into buy territory. I believe the fundamentals look good. It's reported well. Successful M&A of Pontville, record sales, increasing whiskey bank under maturation, increased dollars per litre net sales value. Oh, can I take a breather? Etc. And on face value seems to be an economic moat with no real clear Australian competitors. I'd expect on a fundamental level that it should continue to perform well. Given I am new to investing and still reading your book, my technical analysis ability is limited. It would appear that it is trending upwards and has made consecutive higher lows since the end of May. Would you say that it's a buy once it breaks past its resistance level at 325? Thanks, Nathan. You gave me that one on purpose.
You okay
didn't you?
now? Do you want me to have a lie down? You know, have a drink of water. You okay?
Yep, great. I'm excited about the stock.
And it was more war than peace. Okay, Lark.
Okay, so Lark, looking at it right now, I think we've talked about this one on the show before.
We have.
It is exciting to see little Aussie stocks and a distilling company nonetheless too, which is quite nice if you like that sort of thing. So, look, he's marked in a line in the sand at 325. I would say that's probably a fair call, but it may even be a little bit higher given we've seen these two highs here, short-term highs, one in June and this one here in, what's that one there, just recently, so that's August. Yeah, so it's showing that there, but if it takes out this low, it's going to keep falling. And where to? That's the question mark. So I'm hoping it, for Lark's sake, that it doesn't, that it starts moving back up again.
Well, it's all well and good, all the things he said, but then that word should is also a problem. Because stocks should not have to do everything, and if you should enough, you'll should all over yourself.
Yeah, lovely. Thanks for that.
But it's like that, isn't it? It's like, people go, well, it should do this or it should do that. It doesn't have to do anything. It just depends on whether people want to buy it or whether, they don't want to buy it.
The worst case scenario is that it falls through this low, but then it could rise up, give him the false sense that it's going to continue to rise and then turn, how it did here. I mean, there's a lot of people that probably thought it was just going to continue strongly up from that point.
Is this making sort of a basing type of pattern for a rise, or is it making it just a consolidation before a fall?
Well, currently, to me, it looks like a consolidation before a fall.
That's what it looks like to me.
I really want to see it get above that $3 mark at least. That's the first step. If it gets above that, then it's got a really good chance, because you'll see heaps of these sort of consolidations in the market, and eventually the buyers and the sellers have got to come to some agreement, or they're going to disagree in a big way.
Correct, and that's the thing is, and I think right now the pattern I'm seeing is looks a bit more bearish than bullish. So I'm not as excited.
So we better all go out and buy some whiskey at Lark Distilling then.
Oh, I don't mind a good Australian whiskey. They're quite nice.
Go for it then.
Definitely. There you go. Now we've got a question from Rose, who says, "Hi Dale and Janine. Firstly, thanks for being the realistic, down to earth, and most importantly, accessible education at every level. The context for my question is I have, as well as inherited my shares in My State Financial Tasmania, and have read the recent ASX notice that their latest DRS is going to be underwritten. Now, I've done some preliminary research into this and have basically come to the learnings that it means there may be a red flag here. What is underwriting of dividends, and what does it mean about the company generally? Thanks for opening my eyes and brain." Rose from Hobart. Well done and welcome to the show, Rose from Hobart.
Well, she's jogged my memory, because it's not something that you think about every day. You just think about, well, they have dividend reinvestment plans, and we know what those are, but you don't sort of think about all the technical details behind the scenes, do you?
Well, this is a way for dividend reinvestment plans are the way for companies to keep money in the company. They just issue more shares, so they're not actually paying anything out. So they're not doing any money. So it's a capital management type of thing where they're keeping their cash.
It's a pretty smart decision.
It's sort of like a capital raising in reverse. Sort of. It's strange, that sort of stuff.
But it's good for them. But I don't know, how good is it for the shareholders?
I don't like it for shareholders, actually. Because at the end of the day, what they're doing is, why they're underwritten is because it's a smaller company, this one. And so it's underwritten because they're hoping a certain amount of shareholders will take up the dividend reinvestment plan and get new shares, so that they don't have to pay out cash to the shareholders. So, but what the underwriter is doing is saying, well, if you don't get to a certain level of participation in the DRP, then we'll buy whatever's left.
Okay.
And we'll take part of that. And that's what the underwriting part is. But I don't think it's a red flag. I really don't think it's a red flag. It's for a smaller company like this, it's not a bad little capital management strategy. As I also know, I did look, they did a note raising. So they've got, I think
that was in 2021.
No, I think it was in one this year. There's 65 million something they've raised or something, so at a good rate and everything else, so they can go out and lend money and that sort of stuff. So it looks all right to me. I'm not too worried about it.
All right, terrific.
That's it for me. Okay, well, Janine, it is time we get into our topic for tonight. Now, we've decided this is the right time to help you, the audience, with the question that you have been asking, which is whether the Australian market will crash. So to help explain what's happening now and how markets generally unfold, we're going to share with you 3 possible scenarios for how the market could unfold for the rest of 2022.
Are you sure you're right? You're going to be able to get through this?
Oh, I'm fit and fantastic. I can run a marathon.
Okay. I just love this type of discussion. Knowing this is key to understanding the market and helping investors to make more informed decisions. We also know that some of you have bought stocks just to receive dividends with the thinking that buying into stocks paying higher dividends protects your portfolio from a market sell-off. And we'll address that tonight.
Now, I can't wait to get into this. What was the word you used last week? Was it juicy? That was the word you used. Now, this topic is really juicy, and you don't want to miss a minute of what we're about to share with you. As Janine and I may have to get the boxing gloves out as we give you our opinion, so stick around for this one.
Now, a discussion about market crashes has to start with a look at history. So let's get straight into the chart of the All Ordinaries Index.
Okay, now, geez, there's no beating around with you now, Janine, is there? No. Jeez, straight into the charts. So looking at the chart on the screen, you can see the first example is the 87 crash, the 1987 crash. Now, the market declined by around 50% into that crash. Now, the next important event was the global financial crisis, where the market fell by around 55%. And then we got the wonderful COVID correction more recently. Now, this was around 40%. Now, it is important to note that this COVID meltdown was vastly different from any correction that we've seen in the past 100 years on the market.
Now, Dale, I'm going to play devil's advocate here.
Why should tonight be any different from any other night? Jeez, I really don't know if I like the sound of that, saying, you know, aren't you meant to be saying the angel helping everyone? Or maybe we should just be saying you are the voice of reason in a mad, mad world.
Yes, but for tonight, I'm shedding my wings and changing teams. Are you ready to get started?
Changing teams? Now I'm really confused. Are you supposed to be a devil or an angel? I mean, whatever you are currently identifying with, just let's get on with it, please.
I want to ask you this. Do you believe the way the Australian market is behaving now is indicating that we're teetering on a stock market crash?
Well, based on history and after examining previous crashes, like we've done heaps of times, the market doesn't appear to be indicating a crash of any sort at the moment. But what is a crash anyway? Now, there are differences of opinion. They call a crash when the market falls 20%, or is it just a correction regardless of the degree of the fall in an overall bull run? I mean, currently it appears that more likely to be the latter. So now it's your turn. What do you see?
Well, there is conflicting economic information, but currently my view is the same. Oh no, Dale. I have another question for you. Do you believe the RBA's decision to follow the direction taken by the Fed could cause a crash?
No.
Right.
No.
You're pretty definite.
No. No, that's my thing. But, I mean, interest rates do need a mention, though. I mean, because prior to a stock market peak, interest rates typically rise into the peak and are much higher than they currently are now, or rates eventually unwind as the market corrects. Now, we've had the opposite with interest rates rising after the peak in prices and as stocks fall. Now, this is very different from the global financial crisis that we had.
Yes, but often inflation is rising as a market runs to a high. So that's one thing that struck me, is supply constraints caused by COVID lockdowns created an inflationary effect. Historically, there's more money in a boom and demand rises and we see inflation rise. So the economics are less clear. What this indicates so far is that there is a further fall. If there is a further fall, I should say, it's more likely to be short-lived and followed by another boom.
I agree with you there. So, okay, currently we don't see a crash, but we do need to share with everyone the 3 ways that the market could unfold from here. Now, regardless of whether the market is in a corrective phase, a slowdown or a boom, what is important is that you have an understanding of how markets unfold so that you don't get hung up on predictions or popular opinion. Remember, opinions are like backsides. Everyone has one and not all are worth taking notice of. So what we are suggesting is that you focus on what the market is really telling you and then have a plan to manage your risk. Now remember, it took around a decade for the market to return to where it was prior to the GFC, and while my current analysis suggests that a correction similar to that seen in the GFC is unlikely until around 2025, there will be times prior to this when the market pulls back to take a breather before the next rise.
Okay, Dale, to help everyone make sense of this, what do you think investors should be considering right now?
Not a holiday to Hawaii, I don't know, but anyway. Anyway, I thought I was making sense, like all that. I thought, is this where you become the devil, what did you say, devil advocate? I can't even say it. Don't answer it. Sorry, don't answer that. Now, everyone, the most important thing for investors is to understand at all times, and that is that there are three ways a market can unfold. It can go down, move sideways, or it can go up. Now, if the market were to move sideways or up, investors are generally pretty happy and only become unhappy when it does the third option and goes down. So having a plan as to what you will do if that occurs really is essential. Now remember, no excuses given or taken. If you are in the stock market, there is no excuse for failing to have an exit strategy, especially if the market's falling. But you would also have a plan to buy more shares when it turns more bullish. Okay, Janine, which direction do you think the market is headed from here?
Well, not sure at this point, actually.
What do you mean you're not sure? Since when do you not have an opinion?
Well, I'm trying to play devil's advocate, remember?
Come on, get on that high horse and tell us what you really think, please.
Okay. In all seriousness, based on what's currently known, I believe if the market were to fall from here, it would probably head to around 6,200 points. How's that?
I agree. Okay. Miss Devil Wears Prada. I would agree with that. So if it does, or the market does fall down to that, we will be back to where we were mid-2020. Now, if it goes sideways from here, then it's just a matter of time before the market confirms a change in direction, and we can prepare for that. So if the market were to rise, where do you see it headed to?
All right, let's just have a look there.
Okay.
Firstly, the market has to break above the high of last month at 7,360 points to confirm it's going up. Once it does, that would be more likely to continue up, or the market would keep moving up to challenge that all-time high of 7,960 or 56 points in January 2022. If this occurs, we could easily see a rise to around 8,500 to 9,000 points. Now, you've heard my view, Dale. What do you think? I'm going to put you on the spot.
Geez, I'd love to argue with that one, wouldn't I? I really would love, but I can't, as I've already put out in my weekly stock reports, that if the market were to rise, that it would challenge the all-time high by the end of the year. So I hate agreeing with you. Now, the way the market has performed in the past 3 months, with 8 consecutive weeks up, surely this is a sign that the market is slightly more bullish than bearish, and so your prediction or your projection is not a case of wishful thinking, but a possibility, a real possibility.
Now, you've said before that investors tend to blindly follow the herd and are generally focused on income rather than capital growth. And smart investing is not about income alone, it's about the total return. But we know a lot of investors have been buying just to get a dividend. Do you think that this is a wise strategy?
In the wise words of Dale, no. Okay. Now, I stand by to what I've said. Buying to get a cash handout and ignoring risk is not wise and should not be done, or should be done at your own peril. Now, particularly if the shares are falling in value, as that simply just doesn't make any sense to me at all. In a market crash, you'll give up in capital more than you'll get in income, and so that's just not smart investing. And we need to remember that it took around a decade for prices to get back to where they were prior to the GFC. So I don't know about you, Janine, but I don't buy shares to sit in a capital loss for a decade. But we also need to remember that a company can reduce or suspend dividends at any time, which they did during the COVID meltdown.
Worse, some investors buy without even checking the direction of the share price, when this is the first thing every investor should do.
Well, I agree with that one. What is interesting is around 60% of companies increased their payout ratio this reporting season, and we've seen lots of headlines about higher dividends, and I'm sure we'll have more discussions on stocks that pay good dividends in the future. So if this is something you actually want to hear more about, then let us know in the comments section below. Now, dividends are often used to tempt investors into buying and holding shares and many investors have bought recently believing they are going to continue to receive higher dividends. But Janine, is this likely to continue to be the case into next year?
No, you cannot bank on it. The most important thing investors need to understand is that dividends do change, and this can occur at any time. And the most important thing that investors need to understand is dividend yields they observe in company fundamentals will change as the share price changes. So if a share price is falling, the dividend yield can temporarily appear high. While some companies are paying higher dividends at the moment, the probability is low that they will sustain the practice into 2023. We often see this as a tactic to support stock prices as they fall, but it doesn't always have the desired effect. And if your stocks fall, remember, you're risking more than you're likely to receive in dividend income. So it just doesn't make good financial sense to risk your capital in the hope of future dividends.
Now you are getting going now, Janine, aren't you? Jeez, you're getting fired up. It's about time you got fired up, I hope.
You're the one who's getting fired up.
I know, I'm getting fired. I always get fired.
Yeah.
And I know you do want to talk about all the mistakes people made in the GFC, because that really gets you going.
Yeah, the GFC was a classic example where investors didn't want to sell falling shares, as not only did they perceive they would rise again, but they were happy receiving dividends at, say, around 4.5%, which tends to be the market average. Yet they lost 10 times that holding onto the shares. Getting to 2.25% biannually as dividends are generally paid twice a year. Unless you hold a stock that pays, say, more often, such as real estate trust that will pay typically 4 times, but more frequent payments does not mean that you get more money. It just means smaller amounts more often. I suppose what I'm trying to say is that dividends are not guaranteed, and income investing is not the way to build wealth in shares.
Finally, you got to the point. That's really, really good. Exactly. Totally. Now, you will remember, Janine, that as prices fell in the GFC, many held stocks out of greed, hoping for a return to the good old days. And this strategy failed big time as investors watched their capital being eroded, and in some cases by more than 50% of what they paid near the peak.
Now, I don't think long-term investors want to be reminded of that.
Well, they need to be, so they don't repeat the past. Now, I know we've got some really interesting stocks to talk about, and we will get to that shortly, but can I say right now, it really is important to have some exposure to the market, but it would be unwise to be fully invested until a rise is confirmed. Good portfolio management requires you to adjust your portfolio as the market provides more information about direction.
Never a truer word spoken. Also, if you are a long-term investor and the market does fall, given the current target for the downside, you must weigh up whether it is worth continuing to hold some stocks.
All right, do you have anything further you'd like to add, Janine?
Well, that's probably it for now. I've put my wings back on. So how about we give everyone something to get excited about? It's time to reveal the stocks that we like for the final quarter of 2022, so let's get into the charts.
Perfect. So let's get in the chart. Well, what chart are you going to bring up?
I was waiting for you to press the button. You're my, sidekick, aren't you?
What do you think? I am an elevator operator. Going up, going down.
Yes. Now, you know that we've had discussions on the best stocks in different sectors over recent months.
Yes.
And people really need to go back and have a really good look at some of those previous shows that we've done to look at that. Because I could have picked all of those stocks and I would have had potentially around 50 shares to look at, but I know that you would have got really upset and probably walked out.
I would have fallen asleep. Probably.
But what I'm trying to do here is pick a few stocks that are a little bit different to what I've picked recently.
Ooh, I'm intrigued.
I've kept a couple that I didn't want to let go, but I've also put a few others in there. So the first one is ANZ, and that's because we did the recent show on the bank stocks. So we did the big 4 banks, and then we did a show on the second tier banks as well.
So these are the ones you think are going to finish off the year strong?
Well, look, I mean, this all relies on ANZ's strategy to pick up Suncorp banking. Now, if ANZ gets all of that goes through, I think that this is going to be a big coup for ANZ.
Cool.
So that's what we're watching at the moment, but it's just sitting there. There's always downside risk to everything, so investors need to have a view on the upside as well as the downside on any stock.
So ANZ,
So ANZ does actually pay a good dividend. That's another point. Fortescue Metals, I'm not saying right now, I think that there's a real risk right now if Fortescue continues to fall, and it has taken out this low recently, this low which is in July 2022. Last week it actually looked quite bearish, the sell-off we saw across the mining stocks, the big miners, and it tends to indicate that there could be risk to the downside now. We could even see a retest of that low if it continues to fall. Fortescue needs to get back above this high here in August for it to recover, is basically
But it can take
point.
off like a rocket, this one.
It can turn on a dime. You just think that it's going to fall away and the next minute it goes up. But personally, I'd rather see it fall to the downside now and have that decline, and then we get a great opportunity.
You're talking short term, yeah?
Yeah, I'm talking about sometime in the final quarter of 2022, depending on how it unfolds and falls away, we could have a really good opportunity to pick it up. Okay. But of course, we need the time for it to actually produce some rules to enter as well after the fall.
Because, at the end of the day, people talk about things like, October being the worst month in our market, but more often than not, the lows happen in September and November, not October, because we've done a lot of research.
Sometimes we see high volatility in January, which could happen.
I'm talking about at the end of the year, not we generally see sort of lows happening, and that's what I'm expecting, a low in September.
Yeah,
I'm expecting a low to happen any time now.
Look, the market will be hugely watching what's happening with retail spending in November. So if credit cards get absolutely hammered in November, then the RBA is going to be watching that like a hawk, so it's not going to be great for borrowers if that happens. But at the same time, the market needs to see that spending's in place to actually go up. So typically when we see a positive year pre-Christmas and then coming into the Christmas season, generally markets tend to like that.
Yeah, they do, and they really do like that sort of stuff, but stuff like a lot of those economic figures are still okay at the moment, even though interest rates are going up. But I was chatting to somebody last night, and they're saying, they said to me, what do you think interest rates are going to go to? And I said, well, look, get used to, I'm saying budget on 7%. It may not get that high for you. I'm talking about your mortgage rate, not the RBA rate.
Yeah.
But I said, look in your mortgage rate budget. And she's going, oh my God. I said, well, that's what you got to budget on. I said, because you have to factor that stuff in. It may not get that high, but if you are budgeting it, even at 7%, that's quite sustainable for most people, because that's more normal, that sort of figure. But anyway, I digress. But so we're talking about FMG, a little bit more downside maybe this month, picking up for October, November, December.
Yep, that's what I'm looking at for FMG. Now, the next one we've got is actually a gold stock. Now, you'll notice that all of the first four stocks that I've picked up are top 20 shares, because that's the theme of the night. Well,
that's great, because we're only in three stocks, ANZ, FMG and Newcrest.
Now, we have seen gold. This is, Newcrest. So we have seen gold come off, and then we've seen the gold stocks come off significantly. So Newcrest is actually down from August 2019. It's fallen nearly 60%.
Wow.
Right, so often when stocks fall to those sorts of ranges, they can have a good turnaround after that. So I'll just be watching the gold stocks at the moment to see when there's an indication of a turnaround.
What kind of dividends is this one playing?
Look, I haven't actually looked at what Newcrest's dividend is at the moment, but I think that's not it could be the icing on the cake. It's not the thing that attracts you to a stock like this. You want to make sure that you're getting in at a reasonable time when the stock's moving up, because it is a bit higher risk. Even though it's in the top 20, the volatility of this stock is quite interesting.
Yeah, well, I mean, obviously in the top 20, the best performing stocks were your Woodside and what was the other energy stock? I can't remember.
Woodside's done fantastically, hasn't it?
There's two energy stocks.
STO, Santos.
Santos was the other one. That was the other one. I couldn't remember.
Santos has been a bit more disappointing because of the takeover with Oil Search, and so that's held it back for quite a while. So eventually I think that it will get on and will be a really good share. But right now it's still proving that, isn't it, really?
But I think it's an important point you make about dividends and that, because, I mean, I've never bought a stock in my life because of dividends, and that's the last thing I'd ever do.
Yeah.
And to me, and probably the prime example of that was Telstra, which is a great stock at the moment. It's a little bit of weakness on it, and I do like Telstra at the moment with it, but it has a little bit of weakness. But that went down for 10 years, and people kept saying, I'm holding it. Why? Because it pays a good dividend. Well, do you like losing 60% to collect a 5% dividend?
I know, but from your perspective, that's how you've looked at the market for forever probably. When you look at a lot of people and how they're investing, they're taught different, or they've heard different things, or they've read different things, and so that's the way that they're thinking until you come along and just shake it up a bit.
Well, it is, because they think a dividend yield is sort of like It's a guarantee. It doesn't matter what happens with this, at least I'm going to be guaranteed this much, like it's a bank term deposit. But as you said, it's not guaranteed, and we do need to take that dividend yields with a grain of salt. It's a bonus in my book. It's like tax. I treat anything tax-wise on an investment as just a bonus.
Yeah.
You know, to me, always capital growth, number one. Another
Next
stock, number 4.
Now, it's funny you mentioned Telstra because I've actually got that
Holy
in there.
moly, look at that
I
one.
always put Telstra in there somewhere.
We always
I
hated
talked
that
about
one.
it. I did a podcast recently. I don't know if it's gone out yet, but I like Telstra in the top 20 because it provides the little bit of diversification in a portfolio when you're looking at, so many banks and miners and what are you going to have different. You've got energy stocks in there, and it's just great to have Telstra in there, particularly given what it's done over recent times and with the potential to keep going up. Now, if money gets tight, are people going to stop using their phones?
God, no.
No.
All their internet.
That's what they're going to pay for over and above going out, isn't it, really?
Yeah, you're never going to find people without their mobile phone. It's part of our appendage, and I wonder why people haven't sewn it onto their body yet, because people just walk out the door and just put it in on their person somewhere. I was like, actually funny, a friend rang me on the other day, Sunday, and I didn't return the call, and because I didn't know where my phone was. I found my phone in a spare room, dead. And she goes, well, don't you have your phone on? Well, I just put it somewhere. I forgot about it.
Right.
Like I go out and do all sorts of stuff.
It's funny, isn't it? Because there's only really 2 things that could get me in a panic. A pooey nappy that's not mine and losing my mobile phone.
Yeah. I couldn't care less about my mobile phone. I'd rather leave it behind.
Oh, would you?
Yeah, there's so much more freedom without it. Like, nobody can call you and bother your day. I mean, imagine if you have
Hang on a minute. Am I really hearing right here?
Why?
Who's the person that's critical of me for not answering the phone? Because I don't carry it on me every second.
During working hours. I don't care what you do after that.
I told you we should have a hotline. It's called the bat phone. You need one of those.
I think I'll get a bit batty every now and again. Telstra. So, short-term weakness, looks good long-term.
Yeah, look, I mean, I'm a bit disappointed this week with the pullback we've seen because I was expecting Telstra just to take off.
Go up.
Yeah, from here because it just looks so fantastic. So we're now watching to see what happens. It may just trade sideways for a little while it settles down because that $4 level is really important for Telstra. We need to see it get back above that level really soon.
Sort of doing what you were suggesting earlier in the report where you're saying, if the market might go sideways for a bit and then all of a sudden it'll break out.
Exactly.
And that's what we're seeing down here. We're seeing it's not falling away. It's just holding and holding.
It's held up really well, hasn't it?
So that suggests it's building up for a foundation for a run up.
That's generally what it looks like, doesn't it? I mean, as soon as it takes out that high there, well, the sky's the limit on where this is going to go. It's a $5 stock then.
It's not a sexy stock, but it's a good one.
Yeah, well, I've always said that this stock should continue to be transformational in the way that it's going with technology and the advances that we've got. And I mean, one of the things that I love about stocks that are in the telco space is they've got the ability to increase they can transfer the cost. I mean, there's a lot of competition in the space, but they can still transfer cost increases. Yeah.
You can look at some of the prices that Telstra want to charge you for stuff. It's like, God, geez, rape and pillage, I tell you what.
Well, their share price is holding up, so what do you want to say?
Yeah, I know, but I'm not a client of theirs anymore.
Okay.
To me, it doesn't matter what the name is on the bill. They're all terrible anyway. But what's our next stock?
Our next stock is actually a smaller stock from the mid-cap 50s. Now, because we've seen this
pivot, wow.
Yeah, well, the reason I'm interested in this one, it's quite a volatile stock, and it doesn't look great at the moment. But I mean, historically, there's this massive level across here, which you just decide where you think the level is. It's up to you as an individual to do your own analysis and work that out. But it's such a strong level that if eventually this takes off, it's got nothing to hold it back.
That looks absolutely awesome to me. That really looks awesome to me.
Yep. So that's the fifth wheel, if you like, in the five.
The fifth wheel in the five. Quattro.
Yep. Yeah, that's an interesting one.
That's Cinque.
I mean, there were heaps of stocks I could have picked to be the fifth stock, but this was one that I thought, well, that's interesting,
I do like
isn't
it.
it?
So you're saying above that $4-ish mark, if it breaks up that previous high, then I think could be.
Yeah, well, I mean, I was hearing from farmers saying that they're getting record prices for their produce and that they're having to pay higher prices for fertiliser. So you'd think that
that's it. Go to the grassroots.
We've got to eat, don't we?
Cool. All right, so what you're saying now, just to summarise everything, the markets might go down a little bit more.
Well, we've
6,200
looked at the potential downside at the start of the show, and then we talked about the upside in the topic. People have always got to be mindful of it. It could go either way. But at the moment, until the market tells us otherwise, we have to have the view that it's going up. And then it's a matter of preparing for that downside. Dividends are not the way out of a correction. It's better to go to cash if you have to. That's a better strategy until you know where the market settles, if it does fall. If it rises, well, then we'll be all, quite excited from here, won't we? But I would like to see BHP, FMG and Rio trade lower than where they are today so that we can get some really great opportunities coming up. I'm excited about that.
Whatever. Thanks for my summary. That's really good. Well done. Taking my summary. All right, that's it for our topic for tonight. Now, before we do get into our next email, given you are at this point in the show and still watching it, means you must like it. So that means liking what we're doing. Make sure you hit that big like button now. So just scroll down a little bit with your little pointer, see the big thumb and hit that button and hit the like button. We hope the counter's going up right now. So we're just going to sit here and wait until you do it.
Can I get a drink then?
No, you're going to get a drink. Go out and get a drink. Until that like button goes up, we're not doing that anymore. Hit the like button now. All done? Great. Okay, now, I hope you have your phone ready and been patiently waiting for the opportunity to call in the show and ask Janine and I your most burning questions. Now's the time to get dialing. The number you need to call is 039290 9988. That's 039290 9988. So get dialing now.
While you call us, we will get into answering the next question, so call now.
All right, our next email is from Glenda. Now, Glenda says, "Hi, Dale and Janine, I love your show and I'm thrilled to have completed your short course." Well done, Glenda. "There are stocks that have had a fall near the dividend amount on the ex-dividend day and others that have really plummeted. Does this mean that there is more positive news regarding the general investor emotions on the stocks that don't drop as much, or am I just kidding myself? Thank you, Glenda." Great question. People don't think about that, do they? I mean, BHP fell through the floor last week after paying the dividend. Massive fall.
I mean, there's such a build-up into reporting season, isn't there? And it's all about the forecast, not about what they report.
Yes, absolutely. It's what people think they're going to report.
Yeah, I know. The amount of times I get questions of people saying, "Oh, they just had such a great report. How come the share price fell away?"
That's
it's
when
such a common one.
they always fall away, isn't it?
Yeah.
It's generally the way. When they put out a good report, people try and jump in on it.
I think that's important, particularly for new people when you're getting into the stock market, is just observe what happens around reporting season and observe which stocks go up and which stocks fall away, by how much, and on what dates that's happening. And some stocks will just continue to rise into their ex-dividend date, because often stocks will go ex-dividend close to that time, while others actually peak prior to the ex-dividend date. I can remember watching some of the property stocks and seeing those stocks rise into that, towards that ex-dividend date, then fall just prior. So there's important dates around when a stock goes ex-dividend.
It is. I mean, some people, you can't dividend scalp and stuff like that anymore, but, because you've got those holding rules and those sorts of things with it. But, based on what she's talking about is some will fall just the price of the dividend or around that, and others will fall a lot more. But generally, it's around about 1.5%.
Well, it depends on the stock. It depends on the stock, the liquidity of the stock, and it depends on the perception in the market as to what the view is on that company at the time. So if a stock actually doesn't fall the amount of the dividend, then you'd say the view by the market is strong. If it falls by more than that amount, then potentially the market might perceive the stock as weaker. But it's not always a cut and dry situation.
Okay, not all cut and dry, but thank you for the answer for that one.
That's right.
All right, our next email is from Darren, who says, "G'day, Dale and Janine. I recently saw some news for Whitehaven Coal regarding becoming a substantial holder from MUFG. I find this a bit confusing what it means, but basically it is a 426-page document. And no, I haven't read it all. I'm glad you didn't. Now, can you explain what it means? I think it's basically saying a large financial group purchased over 47 million shares on the 26th of August. If this is the case, the share price on the 26th of August closed at $7.97 by 47 million shares. That's over $381 million. Also, the trading volume on the 26th of August was 15 million, so less than 47 million. What am I missing? Or has this volume been purchased been over a longer period? Regards, Darren.
Well, that's interesting. That raises a lot of things. First of all, it's about looking at what the market capitalisation of this company is and putting it in perspective to understand that dollar value being purchased and what percentage of the overall company is that. And then when there are large purchases being made on big stocks, often they'll find that in the announcements if large stockholders are shedding or buying.
If they're being announced it's now a major shareholder, they don't get there just like that. It's a slow accumulation of the shares to a point, and then eventually they make their intentions open to the market, which is really what this is about.
Yeah.
Saying, here's our intentions, we are becoming a major shareholder, we bought more shares, and now we're over a threshold, because there's certain thresholds that the ASX have in there for shareholders so that we know who the major shareholders are. You don't know all the minor shareholders because there could be thousands of those, but the major ones you should always know who they are. And that's really all that's happened here, isn't it? Really, they just bought shares over a period of time, so you won't see all that volume on one day.
Yeah, that is interesting. And look, if we just look at the chart quickly and where the share price is
looks phenomenal.
Trading at, it's just very bullish, super bullish. So this is the 26th of August, when the share he was talking about at the time he was discussing that. Yeah,
it's phenomenal.
So it's really
would I be buying it now? No, I wouldn't be buying it right now, but I'd be hanging on if I had it.
That's right. Now we have a question from Daniel. Hi, Dale and Janine. I've continued to watch your YouTube live streams, which I've really enjoyed, and since then I've purchased both of Dale's books, Creating a Trading Plan, Trading Log, etc. I believe ResMed has confirmed its continuation in a longer-term uptrend after it crossed a monthly trend line and has had 3 consecutive months up. I'm yet to buy it, as I believe it will come down a little further in the next week or two. Would love your opinion and analysis on the stock. Regards, Daniel. Okay, so we've got ResMed. This is a great stock, and this is one that, we always keep an eye on to see where the opportunities are with ResMed. It's probably the better looking stock in the healthcare sector at the moment.
It is.
CSL's pushing up, but it's at a huge resistance level at the moment. And ResMed is just coming back, settling back. I'd like to see it come back just above $30 and then start to push up again, but it looks interesting, doesn't it?
It does look interesting, and I mean, it has been a great stock to own over the last sort of decade, hasn't it? It's been a beautiful one.
If this share fell away and something happened that we don't know about just yet, if it fell through that 20th of May 2022, because investors always have to be thinking about, well, okay, if it falls back here and then it takes off again, it could mean that it's going to take out this high. Think about the different scenarios. If it falls below this low here in May, then it could keep falling. But it just means sit back and wait, doesn't it? Then because you get an even better opportunity. Absolutely.
I mean, I love this stock because it's in a growing industry. It's in, obviously breathing apparatuses and that, and it is in America. Its headquarters are actually in America, even though it's an Australian company. And I think it's in that big growth health sector that's bound to continue to do well because, people breathing and can't sleep apnea and all that sort of stuff. It's growing and growing and growing. Is
there going to be some joke here?
Well, I was trying to be kind because I'd say a lot of overweight people end up having sleep apnea. So in the US, it's full of people that are probably a little bit larger than they should be. Right. Is that a nice way of saying that?
That's good, yes. I'm glad that
I think it's like 75 or 80% of people in America are overweight.
Really?
It's a huge figure. I was looking at the figure the other day. Massive.
Actually, I read something online. It's that guy with the plant paradox. What's that book?
Yeah,
Your wife originally showed me that book.
Doc Mosley.
Yeah, well, he actually did a whole heap of research and he realised that there were actually some plants that actually prevent you from losing weight. So like zucchinis, the seeds, I think it's in the skin or the seeds, I think it's the seeds in zucchinis, actually have some chemical in it. But if you eat a lot of red onion, the something in the red onion actually counteracts that. So it's about proper food combining as well as
So if I eat red onion, I'm going to lose weight. I only eat red onions, I'll definitely lose weight.
Yeah, you definitely will. I don't know what your stomach would be like.
Okay, can we get back onto the stocks now?
Yeah, let's do that.
Okay, all right. Our next email is from Catherine, who says, Hi, Dale and Janine. First of all, I'd like to say thank you so much for writing your book and running your podcasts weekly. That's our pleasure. I really appreciate your work. I have a question about Brambles. I bought this stock back in March when it looked like it was beginning an uptrend. Since then it's taken off, but it is starting to pull back now. I am not sure whether it's beginning a downtrend now and would like some advice on when to exit. It will trade ex-dividend on Wednesday the 7th of September, and I'm wondering if I should exit then or whether it has potential to trend upwards after this. I anticipate it will pull back even more when it goes ex-dividend. Thank you so much in advance. Regards, Catherine. Nice.
Now, we just look at this chart. This is very interesting, isn't it? So I've got the monthly chart on the left. This is an extremely volatile stock, but I think we talked about this one recently.
We did.
And how it had changed, its whole position, because prior to, if I can just go back in time a little bit. And,
go for your life.
Let's see if I can do that. I need to get monthly.
You've got 3
seconds.
There
we go. Oh, quick, hurry. Now,
looks like nobody wants to call us tonight.
Yeah, I know. I'm feeling a bit lonely.
I know.
Look how the sell-off happened here.
Yeah.
That actually looked really bearish. So at that time, we thought that it was actually going south, and we had all these highs here, big impediment to going up.
So this is November last year.
Yep, and then since then it fell further, but it just didn't take out this low. This was the COVID low.
Yeah, it's holding up.
Yeah, so it held up and it's just started to move up again. So that really surprised us. But the level of volatility of this stock, it's just, you can't have a clear view on it at any point in time because it can just turn on a dime. But when it gets into these nice trends, it's really lovely. It's just that you've got to get the opportunity to get one of these and not be stuck in these choppy sideways moves, which it's in the biggest choppy sideways move it's had in its whole history. So, that's ideally when it's broken out of these highs here would be a better time, but stocks always pull back after that, so you've really got to time the entry on this one carefully.
Okay, so what are you thinking? We know it's going to fall away a little bit on Wednesday because of the dividend, going ex-dividend.
Yep.
Is it worth holding or whether is it worth selling? At the moment, I'm saying hold. That's my thinking.
Oh, look, I mean, it's like you say, it's going to come back, but, seeing it's gone up like it has, if I owned it, I would not be selling it right now, especially given that the longer-term picture could change on it.
Yeah. Yeah.
But you want to have a floor, obviously, in saying that as to where
to have an exit strategy,
Yeah, as to where you how far are you willing to let it fall before you get out? It's really the point, isn't it?
And that's the point. And too many people make knee-jerk reactions based on what they think is going to happen, and that's shooting all over yourself again type
Which
stuff.
is different to having a strategy to
Correct.
exit.
Yeah, because some people will go, oh look, hey, the market's going to crash, so I'll get out of the marketplace, and then it doesn't crash, or
it falls a few more percent and that's it, and turns around and goes back up again.
It goes back up again. So that's why we keep saying you've got to have a proper exit strategy. But I think Brambles at the moment looks all right.
Okay, great.
Right, it's over to you now, Janine.
Well, now we have a question from Max. Hi, investment wizards. Oh gosh,
that's you.
Maybe I should have one of those pointy hats on.
Sometimes you're the sorceress.
Really? Oh, I don't have a wand. So for today, I have a question. Since reporting season has now finished, why is it that the 4 major banks that they did not report during reporting season? Now, 4 major banks are the main driver of the ASX index, so why are they not reporting now? But businesses like Tyro, which is a bank, must report now. Doesn't make sense to me. Yes, I know, silly question, but I think it would make sense to see what the major banks have to say about future earnings and give a guidance report about the state of the current economy, since they got the real figures of how many businesses are currently coping. Thanks from Max. Look, I think that's a great question to be thinking big picture about what's going on, and the banks are really the centre of all of that. But the banks always give information to the market as to what they're thinking, because they have people, it depends. Some, of our clients have their share portfolios with banks, and they actually provide reports on what they're thinking is happening in the economy and the stock market on their website. So
but a lot of companies, not all companies report in the 2-week bracket.
Time.
Different companies, and even the same in the US. You get different companies. The US report 4 times a year. We only report twice a year. 4 times is too much in my book, because it's like, really, what are you learning?
Well, I mean, I think it's a play for the institutions, isn't it? But then again, you've got to keep things transparent. So does it help investors to stay on top of what's going on? And I don't know. I don't know the answer to that one.
Well, neither do I. But don't assume. When do the banks report? I can't remember.
Well, they're different now, because there's one of the banks is actually, I think, split out from the rest of the banks. So.
Okay. It's all
it changes.
And the banks, as Janine said, put out a lot of stuff. But anyway, Janine, we do have a caller on the line. Welcome to the Australian Stock Market Show. You're on with Janine and Dale. Who have I got on the line?
My name is Mac. I'm from the Gold Coast, Dale.
Mac, you're a good-looking dude, I bet, too.
Well, I hope so.
That your wife tells you that, hasn't she? You got a question for us?
Yes, it's about a share, Yancor, YAL.
Okay, Yancor, did you own the stock?
Yes, I do. The reason I rang in is it's gone ex-dividend and it's actually increased in price.
Awesome. That's a good sign, isn't it? So what's your intention? You're holding that medium term, short term?
Short to medium.
Short to medium. Okay, Janine, do you want to talk about it?
That is interesting, isn't it? And one outside the park to see a stock rise when it goes ex-dividend. So that's what we were talking about before, that's the market voting. But there's a whole lot of things going on with Yancoal at the moment. So I think it's important to actually do a bit of a Google search online to have a look at any news announcements that are going out, even look at the company's website for any announcements, just to keep yourself up to date with what's going on there.
Coal is doing well at the moment.
But right now, it looks really, really good. So, I mean, if you were holding this stock, you'd be pretty excited about its future direction.
I'm sure Mac is excited about it. But look at that, it's just so many months, beautiful move, beautiful trending. And I mean, even in the last few weeks, 1, 2, 3, 4 weeks, not even this week's not even finished.
You'd expect it to go up for another week or so, and then
I'd expect at least another week or so. But look at the volumes really increased.
But even if it pulls back, it may still keep going for months. You don't know. It's hard to tell, isn't it?
I think I'm going to retire. Mac can take my job. He can sit here with you.
Beautiful.
I know, it would be, wouldn't it?
Well, that'd be fun, wouldn't it?
Yeah, well, he'd love it. I don't know, maybe you'd like it. I don't know. But anyway.
He might like to fly down. Where's he from?
The Gold Coast.
So that's a long trip, though, isn't it?
Well, it is every single week.
I don't think he'd like to come to Melbourne. If he's in the Gold Coast, wouldn't you want to stay there?
All right. Well, anyway, let's get on to our next email, Janine. It's from Mark, who said, "Hi, guys. I've read the Red Book. That's my book, How to Beat the Managed Funds by 20%. I've never heard it called the Red Book. But anyway, and I thoroughly enjoyed it thoroughly. I'm a newbie to trading. I'm looking forward to life settling down soon and would love to do the trading mentor course. You'll love it, mate. My question is on Life 360. I actually purchased some after reading the book a couple of months ago, then got excited when Dale mentioned them last week. Now, I've just read they're getting kicked out of the ASX 200. I'm just wondering what that means to a share. Is it time to get out as they aren't near my out target yet? Thanks again. Really do love the show. Kind regards, Mark." That's cool, isn't it?
So, do you like that stock?
I love it.
I think it's
got good legs. I mean, it's not making any money. You've got to be careful. It's not a profitable stock, but it's in the tech sector and it's in line with everybody else. It is looking good, but why is it getting kicked out of the ASX 200? Because it had a big fall. That's why its market cap's gone right down. So it hasn't come up enough to stay in it. Because when they rebalance it on a quarterly basis, and that's all that's happened over the last quarter, it's fallen to a point where other stocks will fit into the ASX 200, which means slightly less participation by institutions in it. It'd be more severe if it's going out of the top 100, but I'm not too worried about it.
Look, I just watch that liquidity because it looks quite high. It's just holding up really nicely.
Yeah, it is. It's a good stock and it's a good longer-term stock. That's why I like it. And as far as tech stocks concerned, and this is an American company, it's trying to be market leader. It's not making money at the moment, but how many, like Amazon, did make money for gazillions of years, and look at its price.
Well, we've already, like he said, we did talk about it on the show last week.
So let's go. All right, well, that's our thoughts on Live 360. Now, I do want to thank everyone who has taken the time to comment in the YouTube comments, always taking the time to email us. We really do appreciate your feedback.
You have been asking us questions, and each week as we ask you for your thoughts. Last week we asked, do you believe the market has factored in prior rate increases by the RBA, and are you expecting the RBA to continue to raise rates next month and in November? And should they do it? We loved Blue Army's response. Another good show. Thank you. I think if Fed keep increasing interest rates, which they are indicating they will be, then we have no choice but to follow them unless you want high volatility of the currency like Japanese yen at the moment. In addition, I believe inflation will stick around longer, so we have to increase the rates to suppress the pressure from the demand side. Very interesting.
Very good comments. Very, very good comments. Well, thanks for sharing. And thank you to everyone who joined in and commented. We do really enjoy reading your comments after the show, so keep them coming in.
This week's question is, if you were to sell one stock in your portfolio, what would it be and why? So come on, everyone. This is your opportunity to be heard. Join in and get typing. Please write your answer below this video in the comments section. If you're listening to us on a podcast, you can still send us an email with your answer. Before you do, give us a 5-star rating and review on whatever podcasting app you are using.
I reckon they're a bit slack. They don't do it. How many times we ask and they're not doing it? So I reckon,
I'm feeling like we need to have
into doing it?
Maybe we need to have that on a tape recording so I don't need to say it every week.
Probably, but they're not doing it. So do it. Janine's asked you to. Now, if you enjoyed tonight's show, then give the team a really big thumbs up. That means clicking that like button underneath the video to let us know that you've enjoyed the show.
If you want us to answer your questions, then watch our show next Tuesday between 7 and 8 p.m. Pick up the phone and give us a call, as we'd love to chat with you. If you are not able to watch live, you can email your question ahead of the show. You do this by sending your email to info@wealthwithin.com.au, and remember, please include Wealth Within Live in the subject line.
God, that's a rarity.
I really enjoy seeing those emails come into the inbox. I'm often saying to you, have there any more emails come in?
I know you do,
So
but they
exciting.
don't put Wealth Within Live in the subject line. They don't listen to you. Anyway, we do really appreciate your support, and you can show yours by subscribing to our channel and hitting that subscribe button now.
Well, that is it for tonight's show. We do hope you enjoyed what we presented tonight, and we have so enjoyed receiving all your emails, and thank those who called into the show. We love the opportunity to chat with you personally.
As always, thank you for joining us, and we hope you have a great week. For now, goodbye, good luck and good trading.
Bye for now.